Rahul Arora is Chief Executive Officer at Nirmal Bank Institutional Equities. He's with us here in our studios. Rahul, great to have you with us here. Thanks very much for your time. We get a moment to catch a breath. I mean, corrections are also they just last 30, 40 minutes, like what we saw yesterday, right? We started higher. By 10 o'clock, we were at the day's low at about 19,300 and then spent the day moving up once again. What's the sense? Is it getting a little too fast for everyone's comfort?
So, morning, Prashant. Thank you for having me on the show. So, just I'd reference back to the conversation we had about a month back when I was on the show. I think because the Nifty has spent such a long time in that range of 16,700 to 18,700, I was of the view then that if it broke out, it would probably head to 20,000 before we know it. I think it's more a technical factor than anything else. Obviously, you're a beneficiary of flows. I don't think incrementally any data points have turned positive. I think what was positive a month back holds today. Your rupee is stable. The external sector is fine. Crude is still between 70 and 80. So all of that is known. I was hearing Nigel just talk about one of my competitors downgrading a stock because of valuations. That's a concern across the board. I think, it's very difficult to value stocks on FY24. It's becoming very difficult to value stocks on FY25. And part of the reason, Prashant, is, and I don't really fault the buy side, is because whatever liquidity they are getting, they're pretty much buying the same stocks that they already have in their portfolio. So as sell-side analysts, you can do one of two things. You either increase your multiple or you increase your time horizon, or you do the third thing which sell-side guys love to do, is you do a DCF. So, there is only three ways you can justify when you can't, because you can't increase your earnings beyond a point. So our valuations stretched at this point? For sure they are. Can this leg take it to 20,000? It can, but it'll probably be fueled by liquidity. I think there's still some monies moving away from China. In fact, Prashant, you may have noticed last month was the highest inflows into the US stock market since October last year. So that, and what's shocking me that this is all happening in a very high interest rate regime. So, I don't know whether people have started discounting rate cuts in 24 or whatever and started moving beyond. But ceteris paribus, I think valuations in the near term are definitely a challenge. I think fixed income over equities from here probably presents a better opportunity.
Rahul, momentum always chases performance, right? And that's what we are seeing across. But what have you made of the provisional updates that we've got from the banking numbers so far? HDFC Bank's advances growth is not that high. For Bandhan Bank, their loan growth is 7%. Their guidance was for a 20% growth. The CASA numbers for many of the banks have fallen, so NIMs could remain under pressure. Have what we've seen so far from the provisional banking updates, does it make you a bit worried?
So I think if you adjust for bill discounting and other factors, I think HDFC Bank's numbers will be about 19-20% on advances. I think the reported is about 15-16%.
13%, I think.
Yeah, so I think Bandhan was a bit of a disappointment because both the advances and the deposits came in high single digits and low double digits. But I think the point here is, as we saw the case of Federal Bank last quarter, for example, because that comes to mind immediately where you saw a NIM compression. I think that is probably going to happen for banks over the next couple of quarters because over the last 6-8 months...
We've been talking about NIM compression, right? So isn't it priced in already?
No, and to some extent, and I'll tell you why. I think if you look at ICICI Bank's results over the last couple of quarters, they've actually been very good, but the stock's done nothing. So to some extent, I think it's probably priced in. But the point here is, I think when you look at the banking sector as a whole today, you're operating at peak ROA, peak ROE, peak NIMs, peak asset quality, peak credit growth. Everything is peak, right? From here, if you go into a slowdown, I don't know if you're aware, but the outstanding credit card dues in India today are over 2 lakh crores. It's the highest it's ever been. So if you have a slowdown, you're going to have an issue on retail NPAs going forward as well. Corporates are a thing of the past because corporates have delevered. But I don't think banking is going to be the sector from here at a 46,000 bank nifty that will lead the market up. I think there are a lot of other sectors around it. That being said, is there a bottom-up approach? I still think there is. I think there is still a trade left in PSU banks from a valuation standpoint, predominantly SBI and Bank of Baroda, which reported their highest ever return on equity in the last quarter. I think their balance sheets are in excellent shape, and neither of them are trading much beyond 1. I think a Bank of Baroda might be at 0.8. So I'd probably be inclined more towards public sectors than as opposed to private sector. But now that we know this new avatar is going to take shape very soon with the HDFC family, I'd probably stick my neck out and buy it. I think you have to keep in mind, Reema, that at this base, if HDFC Bank is still giving you a 15% growth, you take it any day of the week. I think when you reach that size, a Hindustan Lever is struggling to give you that top line growth. Infosys is struggling to give you that kind of growth. So I'm giving you parallels from other sectors. At 2.7 times or 2.6 times, HDFC Bank to me should be a portfolio.
So HDFC Bank, Bank of Baroda, State Bank of India, right? So you're comfortable buying these banks?
I would be. And I think if you want to go down the market cap chain, I think something like a federal bank also looks interesting to us.
Well, and that's done very, very well in the last few days as well. That's suddenly come back to life. But we've spoken enough about banks, Rahul, and you don't duck this one in terms of picks from the broader markets as well. Last time you joined us, you told us Westlife, that could easily go to around 2,000 rupees, despite the big up move that you're seeing. Power Mech was another stock that you spoke about as well. Could you fill us in with a couple of names that are looking interesting? Maybe not from a near-term horizon, but someone who wants to build a portfolio. A couple of names that you all are looking at.
So let me turn it back to a sector that I'm very passionate about, which is consumer. I think you can look at P&G and Gillette.
Okay.
I think if you look at P&G, we're expecting, and if you look at the last 10 years, I think Procter & Gamble has actually had the best top-line growth of any FMCG stock in India. What has hurt them, of course, is margins. And I think what we are expecting is a 700 basis point margin expansion between 23 and 25. Because, if you look at wax oils and things like that, which go into Vicks and other raw mats for Old Spice, and even if you look at the female hygiene part of it, the main raw material is pulp, which has corrected dramatically. So I think you're probably looking at a 35% earnings compounded in Procter & Gamble. And the valuations, while they'll probably be at 44, 45 times, this is a 100% return on equity, return on capital employed, and ROIC company. Okay. The other point is Gillette. I think the stock is now starting to show some growth. Obviously, the Virat Kohli culture and don't shave was probably prevalent for a very, very long time. But I think if you see the new brand ambassadors that Gillette has gone into with Shubman Gill and Sanju Samson and the like, I think they're trying to send a message with, and the female part of the business as well with Venus, where I think Deepika Padukone was the brand ambassador, is doing really well. In our last interactions, that's growing by over 20%. So I think Gillette has seen almost a 30% correction from its peak. So I think a couple of stocks on the consumer side, because valuations are becoming challenging in that part as well, as I was discussing in banking. Yeah. But I think where we're reasonably comfortable on earnings growth, these two could potentially be very good stocks to be holding on to. Very classy names, very good return ratios, very good cash on the books. You sleep well at night owning P&G and Gillette. So I think those are a couple of names we definitely look at.
Coming back to banks and financials, Bajaj Finance, Rahul, any thoughts on that one?
Buy it. I'm a buyer. I know there's a threat, partly because the promoter entity of your channel is obviously going to be listing its share in the not too distant future. But I mean, look, 30% kind of growth. Again, well, like I was talking about base effect with Reema. It's remarkable. I don't see, I think with consumer durables, the kind of financing that they've done, IDFC First has done a very good job in getting into that. HDFC Bank's also trying to do its best. Obviously, some stocks, Prashant, like a Bajaj Finance or a D-Mart or an Asian Paints, some of these names get so priced to perfection that the margin for error is very, very little. And then you sort of get a 10-15% fall. But the interesting part, Prashant, is that these stocks don't fall too much because, anything that you see as a slight setback also will be seen as a buying opportunity by institutional investors. So I have no problem buying, even a Chola for that matter. I think some of these stocks are expensive for a reason, and there are some stocks that are cheap for a reason. So I think if any opportunity you get to buy into names like Bajaj Finance or Chola, maybe, the erstwhile HDFC, which was obviously now going to HDFC Bank, these would be buys for me at all points in time. So 30% growth on this base is absolutely remarkable.
Rahul, you track the retail, the consumption, the QSR space very closely. What's the feedback on the ground? Channel checks with your conversations with management.
So I think there is definitely a slowdown post-Diwali, and let me explain it to you very simplistically, right? If you take an urban metro tier 1, person who's maybe say making north of 25-30 lakhs of a CTC, right? You probably have a situation where that person spends about 10,000 rupees a week if you go to a decent restaurant or a movie. So that's about 40,000 rupees a month and about 4,80,000 rupees a year. So let's take about 5 lakh rupees a year, and let's say COVID lasted for about 18 months at peak. So that's about 7.5 lakhs worth of savings that you had. The economy well and truly opened up only around April last year. So when people say that what's happening is structural, I question that because I still think a lot of this is revenge or whatever, that savings that's coming in. And my sense is as you approach 2024, you're going to see a bit of a slowdown in consumption going forward because a lot of this, don't forget, Reema, FY22 was a record year for financial services. Buy side, sell side, banking, bonuses were anywhere between 50 to 100% on CTC. So consumption got a huge boost, over the last 12 to 18 months. This is not going to be sustainable. You need to be a little wary. You need to find companies in consumption that are going to be sort of beat that. Like I was saying, which are very, very close, where consumers are not not going to leave that product. So P&G consumer, if a woman's consuming it, she's not going to leave it. If a guy is consuming Gillette, he's not going to leave it, so on and so forth. On QSRs, like I've said in the past, I think Westlife has done a remarkable job. You look at the 2 years in the build-up to the pandemic period and the 18 months post, it's outperformed on same-store sales growth to any other company, including Jubilant FoodWorks, which is a delivery business. So I still think in the near term, valuations are definitely a concern at 60 times price to earning.
But this slowdown is going to get reflected in the earnings of next...
FY25, I think. FY24
right
will manage.
Right now, we're not at the risk of any earnings downgrade in the upcoming
No, and I'll tell you
season.
why. Because when you say earnings, a lot of this is going to come through EBITDA margin expansion. Right, I think if you look at palm oil prices, crude oil prices, they've all collapsed, right? So whether it's a Lever, Britannia, Godrej, they're all going to give you. You know, Reema, let me put it into perspective. From 2013 to 2023, Lever grew its top line only by 8.8% compounded. But the margins went from 13%, 14% to 25%. And they compounded earnings by 17, 18%. That's why the stock went from 300 to 3,000. I think consumption, even going forward over the next 12 to 18 months, is going to be more a margin expansion and earnings story rather than a volume growth story.
Okay, all right. And final question then in terms of autos. We just had the monthly numbers. We've got a couple of big launches as well that you're more a car person, the plush cars, the fast cars. But what do you make of the two-wheeler premium biking segment out there? Because that's going to be quite interesting, particularly for me as a consumer, not from a stock market perspective.
No, so I think it's a very interesting question because, you know, the only person who can lose market share is who has it, right?
Yeah.
There was a time Maruti had 100% market share in the auto market. So obviously, Eicher is going to face a little bit of heat from Hero. The question is, what does that 93% market share in that segment come down to? Can it come down to 70%? I don't think so. Right, I know Hero has its own distribution, but this is going to be a slightly longer-term game. When you talk about monthly sales numbers, just look at the last 1 year and you'll get your answer. Eicher has outperformed everyone else by some margin. In fact, even for the last month, while everyone was struggling, Eicher grew 20%. So if you actually did not have Hero launching the Harley, bike yesterday, there's a good chance that Eicher would have been up 4-5% yesterday because of the strong auto numbers.
Yes.
So I don't see it as too much of a threat. I think it's a 27% return on capital employed company, almost a 21% return on equity. The good thing in the Hero's favor, Nigel, is that it's a 5% dividend yield company by FY25.
Yeah.
So, that is a very, very big factor when we're forecasting our numbers. But I don't think there's too much of a difference on the return ratios. But I think the growth that Eicher will show will in FY24 be double of what Hero will show. I think Hero will probably give you a 12% top line growth. Eicher will be 24%. So I'm still comfortable paying the valuations. I think you probably use yesterday's correction to buy into the stock. If I was to own something in the mass market, I'd play Hero. But in premium, if I was to buy only one stock in two-wheelers, it would definitely be Eicher.
Oh, good thought. You know, when we were growing up, Rahul, when we were dreaming about riding a big bike, there was just one. The youngsters today are lucky. You know, they'll have 3, 4 in the next few months. So
you're young enough yourself, Nigel.
All right. Thanks so much for that.
Pleasure. Thank you for having me.
In fact, let's